what's your advice for first-time investors, property investors?
Investment strategy is a lot easier because there's no emotion. I'm like, 40 grand.
Yeah. How old were you?
I was 24.
And then what happened?
I was like, I'm the smartest guy alive.
Where do you see property in comparison to those other markets like shares, equities?
I've bought quite a few properties through Lachie. Most of those I never even saw.
Correct, which concern me at times. You put a lot of trust in me.
Best purchase you made?
Best purchase.
Biggest mistake?
Oh, jeez.
Time in the market is more important than timing the market. Do you call bullshit? You're listening to the Folio Property Podcast. I'm Reece. I'm here each week with my co-host Lachlan and to unpack property strategy and the steps to scale up your portfolio. If you're enjoying the podcast, do us a favor, hit like, hit subscribe, and leave a comment so we can help grow the channel, get more amazing guests like the man sitting next to us today, back for round 2. Won't give him a big wrap up like we did last time. I think we'll just keep it to Nathan Hood from Carbon Group. Welcome back, Nathan.
Thank you. Good to be back.
Mate, it was high demand. The audience loved it, so we had to get you back.
It's a great feeling. Everyone loves tax.
Well, Lachlan did say on the end of the last episode, I had to keep cutting him off because I think he could have kept going and going and going. And we did want to get you back again because we wanted to actually talk more on your personal story, referencing that, but also from mistakes that maybe you've made on the journey from a tax perspective would be quite interesting too.
Well, that's it. I think our job here is to see how we can build out portfolios, and there is more than one way. We're very clear about that. So it'd be interesting to see your journey, where it started through the lens of an accountant, how that's led your property making decision.
Yeah, nice.
So where did you start? What was your first property?
My first property. So my first property was my main residence. It was in Rangaroo. I didn't really have enough for a deposit, which meant that I was definitely willing to have a punt. And it was at the tail end of the 2007 boom. So I bought it in 06. I remember buying it. First property I walked into, I'm like, I like this property, I'm going to buy it. People are like, don't buy the first property you go into. Went to 4 more. That first one was way better. Bought that. By the time it settled, I think it had gone up maybe 10%. The agent's like, I could put it back on the market. I'm like, 40 grand.
Yeah. How old were you?
I was 24.
24, yeah. That's 40 grand when you're 24. That's,
met
that's
the
a lot
world.
that's a lot of pub money. And that was the peak period of the boom in Perth, right? So by the time 28 came along, I'm sure it would have been much more than 40 grand.
Yeah, so I bought in March 06 and then I bought into my first business in December that year, and we had it revalued, and it went from 290 to 380 in that little window. And I was like, I'm the smartest guy alive.
Yeah,
and then I think it
am a
didn't
pro
move.
investor. Like a rising market, everyone's an investor. You go to the barbershop, and he's like, you've got to invest in Mangaroo.
Yep.
And then what happened?
And then it didn't move for the next 15 years.
And I think that's important, right? Because in a rising market, which we're experiencing at the moment locally in Perth, but also our clients in Queensland and Adelaide, they've all gone through, micro booms, I'd say. Everyone, and you'd see it, you're in the accounting world, right? All your clients. It's funny the sentiment of people's confidence in just being so definite on property advice.
Yeah, everyone becomes a genius very quickly when things are good. And it's interesting watching. So as an accountant, we talk about property a lot in how it fits with different clients, whether it's commercial for their business or investment or their own residence. And when the market's been soft for quite a while, everyone becomes very anti-property. And then after maybe 2 or so years of positive times, everyone's back in again. And they're all up and about. They all want...
the great be greedy when others are fearful and fearful when others are greedy. It's the opposite. It's a herd mentality.
Correct. They just feel like it'll keep going up forever, and they rush to make purchases. And we definitely saw that in 2007.
Do you think we're in that in 2026?
The sentiment has definitely changed. People are...
Going into 26. We're in 25. I've skipped a year
Financial years.
Yes.
Everybody is pro-property. There's a lot more discussion around how do I get into my next property, and so it's a lot more enjoyable. How far we're into this is hard. It's very difficult to see the market softening with housing shortages and with the number of properties on the market. But all good things come to an end. It's just a matter of when and being able to make sure you don't overcommit towards that tail end. And to make sure you don't overstretch your personal situation. Because if prices stabilise and start to come back, but you're comfortable, then Nothing really changes. It's just a headline figure, really. But it's how does it complement the rest of your strategy.
And so after that first property, you know, for those at home, you're not just an accountant, you're an avid investor, not just in property, but other asset classes as well. Where does property sit for you? You know, where's that journey taking you? And where do you see property in comparison to those other markets like shares, equities, those sorts of things? Business, you know, investing in business, crypto.
So I invest
There's nothing that you don't touch, Nate, so it's a really good
I
conversation.
try to touch a little bit of all investments, but everything's got to have a purpose. So we're in this to make money, and the headline figure being the value is really just a headline figure. We're really in it to know how is this going to contribute to the income that I'm able to generate as a passive return at whatever point in time that is for us. So at the beginning of your journey, most of your income's from working, whether that's wages or whether that's business. And over time, you want to transition that to the investments generating that same level of income that you want. And so whether that's property, whether that's shares, they all deliver some sort of income. And then you've got your side investments, whether it's speculative shares or crypto. They're there to just get capital value so that you can take that capital value and inject it into something that's going to give you a yield.
So then, and this is important because when we talk about portfolios, we talk about the life cycle, and typically everyone has a different story how they got into property. Yours was, I just want to buy a property, walked in the first one and said, I want to buy it. I'm sure you didn't have a retirement strategy at 24. No. But with all the clients, and you've seen thousands of clients over the years, what's the common trends? Is it trying to get to that goal of retirement where property is generating me a yield?
Yeah, so I view it all as two separate lines. So I've got my personal line, so the quality of living that I want. So that's my personal place of residence.
It's a bucket where that becomes very emotional, and that's what you want to live.
That's where I want to be. It's ticking the boxes for where I am in life, and I always want to be improving that. So I've got an end goal in mind that I want to eventually get to, and how does this give me the building blocks to get to the next one? So my own story, the first property gave me the foundations to then go shopping for the next. I like to have my next house already purchased years before I'm ready to live there.
Landlocking the location.
Spoke about that in a previous episode, actually, yeah.
Also knowing where I'm running towards. It gives me the energy and the fuel to run super hard in business because I know it's getting me to a location that I'm not yet living in, but it exists. It's real. I know the house. I've been through the house. I know as soon as I can sell the current property and owe a certain amount of money that I'm comfortable with having as non-deductible debt, I can then trigger that and move in. So that gives me the energy that I need.
That's interesting. So you actually purchase it prior to moving in. And I have seen this done where it's sort of, you'll upgrade, but you'll rent it out for the first...
Rent it out, get whatever tax benefits I can, and we touched on this.
Because if it's an upgraded property, therefore the rent's going to be significantly higher, but also probably the negative gearing is going to be great. So you're going to get all those benefits, but you're not going to give yourself the self-gratification of moving into that dream home, even though you've bought it, so you're paying today's prices, not 2 years' prices, until, you feel comfortable, and that's...
Yeah, correct. So I don't want to buy something that I can afford today because I'm only going to be upset with that tomorrow when I can afford slightly higher. So this gives me the ability to stretch a few years into the future, what I can't afford yet, but I can with the benefits that come with the negative gearing and the rental income. And then I get to wait for the market to lift on my property till I transact on that, use those proceeds to pay down the one that I'm moving into, and then I can use those proceeds to go shopping for my next family home. So that's been my family home strategy.
So you stretch yourself hard, and then rent it out, get all the benefits, depreciation, negative gearing, and the motivation that I want to live there, but I'm going to have to run out in business in life to get myself an opportunity to be able to afford that. So then the debt, when you do move in, is more comfortable. It's not at potentially at 105% LVR, might not be at 90% LVR. Where do we feel comfortable?
Yeah, so I've always kind of used about a 500,000 figure. So if I've got less than 500,000 as non-deductible debt, that's something I can maintain fairly comfortably, and I want to transition more of my debt to investments so that you do get the deductions.
Okay, so the house is upgrading and probably significantly in terms of value, but your debt figure on that home
stays the same.
Tries to stay.
Interesting.
And how did you come up with your strategy? So It's interesting. I've never really heard someone talk about that as a consistent strategy for land banking and kind of giving that motivation to get into that principal place. You've obviously, avid investor. You've obviously been buying investment properties through that transition as well. How do you set yourself a goal or a timeline?
How's that difference between your personal strategy now and your investment strategy?
So they don't overlap. So the house was always the house. The primary residence is worth its weight in gold by being able to transact tax-free on some of these assets is really important and part of the journey. And the investment strategy is a lot easier because there's no emotion. I'm an accountant by trade. Everything's numbers on a page. I've bought quite a few properties through Lachie. Most of those I never even saw.
Correct, which concerned me at times. He's put a lot of trust in me.
He walked around with his camera. I saw him a few times in the mirror. I was like, this looks real. But the numbers just need to stack up. So I'm not living there. Anything I feel about the property is biased to myself. It doesn't change the fact that Lachie thinks it's an attractive property from a capital uplift or a rental uplift. I'm only going to bring different sets of emotions to that aren't relevant to that transaction. So if you've got somebody that can help, that's what investments are for. Like, I love the share market, but I have people that specialise in this that I bounce ideas around. So I'll come up with a strategy. Like, these are what I'm thinking and for these reasons, and get their opinion as to why I'm right or wrong. And then I get to make the decision, okay, well, yes, that's confirmed that these 7 of the 10 are good purchases. Do I still want to do the other 3? One I want to because I've got a soft spot for that asset, and the other 2 I won't because I missed something obvious that's obvious for them because they get to specialise in it.
Yeah, key words there, I guess, is you just separate the emotion from the investment.
And this is where, like, if you convert your home that you've done all the bits of love to, so you've put the nice light fittings in and you've made the gardens all nice, and then you turn it into a rental property, all those things go away. The things that the next person that's buying it as their home is going to pay a premium for gets lost during that rental window. And the longer it is a rental, the more you can walk into a property and say, this is an ex-rental.
Yeah, exactly. That emotional appeal, which drives the values, becomes a little bit dormant.
So I typically use that window, and historically it's been about 3 years where I've held the property. I use that time to do all those bits, the little renovations, the extra bits of kind of love to the property that are going to either attract the husband or the wife. So, the typical rule of thumb, the husband likes places that he can put his toys in, the garage, the shed, the man cave. The wife likes different areas, the kitchen, the bathrooms. So you make all them kind of look the part, and you attract the family groups that are willing to pay a premium for something that they emotionally connect to. And then by getting that premium, that gets me closer to moving into my next house by trying to maintain that kind of 500 grand cap. Yep. It's always been my
ethos. So we talk about that. Like, I often meet with clients and we refer to debt to income because that's really the ratio that the bank works off, right? They will lend you somewhere between 5 and 6 of the debt to your current income, right? And that income includes some of the tax benefits we spoke about in our previous episode. It talks about the rental income that we're going to get from the property, so it encapsulates all the income. And something that I guide my clients on is trying to cap your debt on your home at about 2.5 times your debt to income, maybe 3, because then it gives you that 2.5 to 3 to work in your investment space. What do you sort of make of that?
Oh, I typically work around a fixed number. Okay.
Because the bank's only going to give you X amount of dollars, right? Particularly if you're a PYG.
Correct. So you're going to be limited as to the amount of debt that you can borrow, but I'm very pro-debt. I think debt in modern society is almost a must. So unless you can establish a comfortable relationship with debt...
And this is coming from an accountant.
I'm typically anti-debt, my industry. Everything's pay down the home and be cash flow positive. But I just don't think the way society works now allows you to get ahead unless you have an appetite for debt. Now, obviously, you've got to cap that debt at an amount that makes you feel uncomfortable, because if you aren't comfortable with your debt levels, then that affects performance and other things. But
you start to need to educate, and the way to get comfortable with things is being knowledgeable, right? So you get comfort by listening to podcasts or reading books. But I think you're right. I always, conversation with clients, you need to get comfortable with debt as soon as you can if you want to get ahead, because your retirement goals, you're a long way from where you want to be. The only way to get there is taking on more debt.
And correct. So the only important part to that is being very strategic as to how to transfer debt from a non-deductible environment, being the debt on your primary residence, to being in a deductible environment. Because $1 million worth of debt at, let's say, a 7% interest figure is $70,000 worth of interest that you're paying every year. If you have that in a deductible environment and you're at the highest marginal rate, you're getting back nearly $35,000 of that 70 to help you service the rest of the loan. Whereas if that's for your primary residence and it's non-deductible, you don't get any of that back. So if you're only on 150,000, let's say, and your take home from that's maybe 115, if 70,000 of that's going in interest that you don't get to claim back,
it makes it very difficult.
It makes it very difficult for you to do anything more.
Yep.
So
you're really just becoming a slave to your mortgage in that scenario,
and
right?
you're never paying any principal off because you're just
surviving.
Scraping the interest.
And that's why keeping your debt lower on your primary place of residence, like you've done in the past, where it's almost delayed gratification, where you're buying it, your future primary place of residence in advance, knowing that you're going to get the deductible debt on it because it's an investment property. Then it sort of allows you to get ahead in your personal world while you're still getting the tax benefits before you're moving into it. It makes a lot of
sense.
Correct.
So if it is that $1 million that I would have otherwise had additional in my non-deductible debt, effectively that's an additional $35,000 a year, ignoring the extra rental income, etc., that I can push down on the loan to help bridge that gap to get it closer to the $500,000 I want. And if you've already locked the place away emotionally, you already own it. And that is your house. You're just not actively living there. So knowing that you've got all those bases covered, you can put in another year or two in the house that you're in because it's real. It's right there. It's not something that might get away from you by the time you go to buy it in the future.
It's a really good strategy. 2 keys out of there was be comfortable with debt and delayed gratification, buying something that you reward yourself with later.
Yeah,
it's really interesting.
It's a really interesting strategy. Like I've not come across that, so it's been good to hear. What about, I want to go back to your first purchase. So you mentioned you had those highs the first couple of years where the market did a lot of the heavy lifting, but then you had the stagnation period. What did you do during that period? And
what did you see clients do? Obviously,
yeah. Did you buy other properties, or is that when you started to look at some of those other asset classes that you mentioned or
other states?
Yeah.
I was probably a little bit more naive in the property world back then. I being quite young, I treated that as a learning window. So what is the market doing? What can I learn from this? At the time, Sydney and Melbourne were very cheap. I wish I poured everything into those markets. But I definitely learnt the difference between states. So not all properties the same within one state, but definitely cross borders. Markets can be very different. So Perth can go through a boom related to mining, whereas the financial markets of Melbourne and Sydney could be in a flat period. So opening your eyes to what might be available elsewhere is really important, I think, in building out an asset class. The luxury with shares is that you get to do that in one place. So if you've got your ComSec account, you can buy Australian shares, you buy WA-based companies, you buy global-based companies. So you've got all these options just from a click of a button without having to see anything, but it's very difficult without physically getting over east or overseas to buy any of those exposed properties. But it's well worth being aware of what that market is doing and has done, because there could be better opportunities cross borders once we hit sort of the top end of our cycle. So it's something I didn't do back then, but I definitely want to be more open to during this process. But I'm a big believer in not having just one thing. So
diversification.
I enjoy investing. I like dabbling in different things. I've got different, comfort amounts. So if I'm going into something speculative, the amount I'm willing to gamble, because the speculative market's not really investing, it's more a sign of gambling. It's a figure that I am comfortable losing. So if it was 5,000 or 10,000, I put that in, I expect to never see it again. If it does well, that's like a bonus.
Yep.
But then there's investing and how much do I put in? Can I leverage it? Yes or no? Because if you can't leverage an asset, then it needs to perform far superior than something you can leverage.
Yeah, and that's a really good point, because I get in conversations all the time, clients will go see a financial planner. Financial planner will say no property because they get paid when they give advice and buy into financial products such as shares. So then the client will come back and say, financial planner said no property. my answer to that is, just ask him the compounding effect. Ask your financial planning and make him to be very, very honest, the compounding effect of leverage over time. And this, for me, is just a silver bullet when you compare property versus shares. Do you talk us through that? Assuming that it's not readily available or very common for people to gear up heavily when they invest in shares.
Yeah, so again, being very pro-debt myself, that forms part of everything I look at. So I have a good share portfolio. I do leverage against my shares, but you can't be anywhere near as aggressive. So property, if the bank will lend you money at the beginning, they typically don't look at that again unless you stop paying the bank. But if the property drops in value or is perceived to have dropped in value, the bank typically doesn't revalue it and say, you need to give us 10 grand. But in the share market, every day the share price is listed, and if it drops below the acceptable levels, you get this thing called a margin call. So it's a very high risk area. And if you do go into that space, I would definitely be deleveraging down. So don't go in at the max like you would with a property.
When we say max, we'd like a typical loan on a house is 80%, right? 80% LVR.
Yep.
Where in the share market, that would be very high exposure.
80% LVR is just the cream. So the likes of your CBAs manage to get up there. But again, you wouldn't want to be anywhere near that, because if it goes over, they then want you to start selling some shares and paying down your loan. And that's kind of the domino effect that you see when we do go through a share market collapse. Margin loans all get called in, forced selling occurs, it makes the market drop even further. So it is a very high risk playing field.
And I think the general public wouldn't feel comfortable taking on debt in the share market.
No.
So then the argument is that 100,000 that you're going to invest in the share market, if you see what we've seen, a doubling event over a 7 to 8 year period, you've turned your $100,000 into 200,000 versus property, that same 100,000 leveraged at 6 times your income, we might get that up to, say, a $600,000 per purchase. A doubling event occurs over a 7 to 8 year period, which we've seen in multiple cycles over the last 30 years. That $100,000 has now just converted to $500,000, so you're 5x your money. That is the power of leveraging property.
Correct. And exactly right. So, if clients are leveraging their share market, I typically tell them to stay around that 50% leverage. So 100,000 might get them 200 exposed, but the same 100 at 80% leverage might get them a 500 grand property, if they still existed. So they're the things that
They do. They're just harder to find, but they do.
I'm still reeling at the 400K mark for your first property in Marangaroo.
That was 290.
Don't buy them. And then from the lens of so your client base and obviously you're giving advice around portfolios and how to structure them, what's common themes that you see, either be that pro or negatives in terms of tax advice when it comes to building out a portfolio?
So there's two different sides to building out your property portfolio, or what I've found for my own personal portfolio. I think we got to a stage where it became very obvious that Perth was quite cheap. So rental yields were quite positive. It just felt like there was no further movement downwards that could happen. And so my personal strategy, with the help of yourself, in a few of them, was to just buy good quality parcels of land.
Blue chip,
So things
high
that
land
had
value assets.
The downside to those, though, were they typically are older dwellings. And so a lot of maintenance costs. They had very low rents because older dwellings. And so they do take up a lot of your cash flow reserves. So unless you're in a strong income position, it's very hard to accumulate those assets.
At scale.
And so what I found was buying those at the right time gives you the biggest bang for your buck. So, you bought me a property, I think in 2021. We picked that up for just under $1 million.
$980.
You remember that one?
Remember every purchase.
Again, I think that was a phone call and you're like, I found a great property. Do you want it? I'm like, yeah, right, let's do it. You're like, do you want to see it? I'm like, no.
Yeah. What's the numbers? Yeah, exactly. We thought we could pick it up for 1,050. We went hard. We got it for 980. I remember the strategy.
And we've just moved that on for, I think, about 65% increase 4 years later. So that same property would have done absolutely nothing for the 15 years prior to when I bought it. It would have been losing me a substantial amount of money every year to maintain it. It would have been getting a low rent. I would have been paying a lot of interest on it. And it would have given me no gains over that window. But then this small 4 year period, all the gains have happened It's cost me very little to maintain because it's only been a 4-year window. So I think
And you bought a gem asset from a killer buyer's agent. I think that's what it comes down to.
I think all yours are gems, aren't they? That's what you keep telling me.
No, but you're right. That's where a moment in time, and we talk about it all the time on the podcast, is time in the cycle. And, that's, you get those things right and you get the asset quality right, location fundamentals, and the timing right. And that's when you get those sort of results.
Correct. And there's no need to be waiting for the market to move. Like, the last thing you want to do is compete with other people. And so it may mean that you jump into the cycle where there's still a little bit of downward motion. But it means you get to pick the good quality blue chip assets. Like, the assets that we're talking about wouldn't even come to market now. They'd be snapped up by buyers agents like yourself that would be able to get in there first. So being able to pick what you want. Yes, you might lose 5% in the initial first year, but that's not where you make your money. You make your money when the cycle goes. Yep. And you've just got to be patient to hold on and know that you bought it for an intended reason. And when you're talking property, you just have to have at least a 5-year horizon. Correct. Before you've got any chance of making your stamp duty and your selling agent fees back on the property. So
puts a lot of pressure when you have a short-term view, and a lot of people talk about flipping properties, trading properties. But as an accountant, when trying to flip a property within a 12-month period, it doesn't make tax sense, does it?
So less than 12 months, you're paying straight income tax. You don't get the capital gains discounts. Your buying and selling costs are far too great as a percentage. And that's where things like shares do complement. So if it's a short-term horizon, you can sell $5,000 worth of shares. You can't sell a couple bricks of a property. You're kind of committing to that.
And you need to give the cycle time to mature to get the larger gains.
You do. So again, those good quality assets may not generate the income yields that you would otherwise want, but you're in them for your capital gains events. So during this last kind of five years, my income position's been stronger. So I haven't needed income from these assets. So I could target a capital gains approach, which is, what are the assets that are going to give me the best
higher
uplift?
land value assets.
But you don't always have that opportunity. And so then you've got to be smarter around, okay, well, what assets can I get? Do I get one good quality blue chip land asset, knowing that that's going to take all my servicing away? Or can I afford 3 higher yielding
villas, which we've taken a position in the last 12, 18 months?
Which will still do quite well, but they're cash flow neutral or closer than what a land bank play would be. So it's just all got to fit what...
It's circumstantial.
Correct.
Got some quick fire questions for you. Best purchase you made?
Best purchase.
Sure, Lachlan was facilitated in that.
Yeah, I think we caught up for lunch and Lachlan mentioned he was starting to target some properties in Duncraig, and I'm like, I like Duncraig. And went out there to see the site, and the one next door was for sale, and called him. I'm like,
buy them both.
If I buy both of these, can we do 8? He's like, yeah.
And pretty unique subdivision site. Right?
We just went to work, one agent each, and I was happy to know that we both got the same price, so it made me feel a bit better about myself.
Biggest mistake?
Oh, geez. Biggest mistake was in commercial property. So I bought an asset in around about our commercial boom window. It was about 2011. It just had no upside. It was just a basic unit within a bigger complex of units, had strata fees.
And what was your logic for buying commercial at the time?
It was just, I had a business and we could be the tenant, which all fits really well. Yep. But the underlying asset itself just had no upside. So I would get just your typical CPI increase, but without upside. So no development upside, no uniqueness about it. Yep. It's just kind of been there without giving any real benefit. But it wasn't attacking my servicing because at least it generates an okay yield, but there's been no appreciation to it.
Nice. And lastly, what's your advice for first-time investors? Property investors, that is.
Be clear on what it is you're trying to achieve. So for me, breaking those 2 lines up, is this to get me into my next family home versus is this something that I'm buying to make a income yield or capital growth on? Be very clear of those differences. So a lot of people have bought 2 investment properties with the concept of, I'll sell both of them and then buy my family home later on. But by the time you sell them, pay your tax, pay your selling costs, you're a long way off the 8 ball to then afford the family home that you want. maybe consider a strategy where you're just buying the family home earlier and getting what it is that you want. You just might not be able to live there for a few years.
Yeah, it's been a real key takeaway of that. So thanks for sharing that upgrading story. I think a lot of people listening will think about that in more seriousness, knowing that there's so much upside from a tax perspective to buy that next home now. So and delaying your gratification by moving in.
And you know the drill, Nathan. So we like to end the show representing our roots that I call bullshit. Question we've got in today is: time in the market is more important than timing the market. It's one we've spoken about several times.
So
do you call bullshit?
I do call bullshit because I think property, when you look back, property does have a trend of continuously going up. And so people will say, I could have bought that for 20 grand, it's worth 2 million now. But what they're not looking at is at different cycles of the market. That 20 grand might have gone to 400. You might have been able to transact then, take that 400, buy in a different market. That 400 goes to 1.2, transact then, buy in a different market. And so that same 20 grand might have been 8 mil worth of assets because you've been able to diversify, re-leverage, or plenty of other factors. Yes, that single asset might be really valuable in the future, but over what period of time and at what other cost?
Beautiful. Thanks for coming again, Nathan. You're welcome back anytime. You're listening to the Folio Property Podcast.